So I'm the Chief Strategy Officer at Tier Capital, and we're an alternative asset manager exclusively focused on the digital asset space, especially as it relates to yield generation. My partners are all ex-commodity traders who have been trading for the last 15, 20 years and have specialized in stripping out the volatility in asset classes like energy, oil, natural gas, and then turning that into yield. We do something similar in the crypto space where we take Bitcoin's 40 to 50% implied volatility, we strip that out, and then we turn that into yield in Bitcoin on Bitcoin terms. So we're very focused on the institutional space within crypto, and we're very focused on yield generation.
Awesome. Thank you very much for that. Good to have you here. Etienne, how are you?
Hey, doing great. Thanks a lot, Richard.
Good. Maybe you just want to do the same. Give us a little bit of background to yourself and what you guys are doing at Melo Protocol.
Yeah, sure. So my name is Etienne. I'm the head of ecosystem at Melo. A little bit of background. So I've been working in finance, structured finance for like a little bit more than a decade, I would say. And then fell in love with crypto and more specifically with DeFi in 2020. Started working there on on-chain indices and then eventually joined Melo to manage everything related to partnerships and ecosystems. On the Melo side, so we build vaults. We've been building vaults for 5 years, since 2021. We are building ILM systems, so active liquidity management system. We're also building restaking systems and now full stack asset management vaults, which is what we're using with Rootstock and Tier more precisely now. Yeah.
Amazing. Thank you for that. Well, welcome. It's great to have you both. So before we get into it, all views shared on the webinar are their own, may not reflect those of the companies that they work for. And also, please don't take anything we say as tax, legal, or financial advice. Also, the audience, you have the ability to submit questions to the panel, so please do so throughout. And like I say, today we're talking about Bitcoin and taking it from digital gold to productive capital. There's been a huge shift in institutional focus in Bitcoin, right? If you look at what was used by institutions in the Bitcoin space 2 or 3 years ago, we've seen a 10 to 15x increase, and that's been driven by a number of things which we're going to go into. Obviously, ETF markets is a huge thing, and that's brought a lot of the institutions in, got them used to Bitcoin as a whole. But there is a tension, and 99% of Bitcoin is still not utilized in a productive way. It sits usually in cold storage, in ETFs, or on treasuries' balance sheets. And so the goal of this and the question that we want to answer is taking it from a theoretical standpoint of what is Bitcoin and how do you take it to an actual operational productive capital piece. So also, Etienne, Tyler, we've chatted quite a bit, but we want to make this a discussion. So feel free to answer any questions as and when. I'll call on each of you, but jump in whenever you want. So first thing to talk about is productive Bitcoin. When we talk about Bitcoin becoming productive, we mean many different things, and it can be many different things to different people. But Tyler, why don't you kick things off? What does productive Bitcoin actually mean for an institution?
Yeah, productive Bitcoin is really interesting, and it's somewhat synonymous with yield generation. It's something that I think is a very loaded term because yield generation can mean many, many things. But what's key to understand about productive Bitcoin, it means putting your Bitcoin to work in a way that's stacking more sats or earning more Bitcoin year over year as yield. So just very simply, it's taking your Bitcoin, putting it to work, making it a productive asset rather than a cost driver.
And when you talk about you're putting it to work in your, what are some of the things that people are looking at in terms of like minimum requirements, right? So are they talking to you from an allocation perspective in terms of liquidity, in terms of reporting? What sort of questions do they come to you with?
Yeah. Well, I think the first thing that a lot of people bring up is, wait a second, I don't think about Bitcoin as a productive asset. Where does the yield come from? Ethereum is more synonymous with yield generation due to the native staking that is inherent in the protocol, which we all know Bitcoin doesn't have. But I think one of the keys to understanding Bitcoin yield is that derivatives can have yield, and the volatility of Bitcoin is actually where the yield comes from. So things like market neutral strategies, arbitrage strategies, these are the yield generation, 101 principles that we talk about a lot of times with allocators. But understanding custody requirements, where are you trading, what does the liquidity profile look like? These are all questions that come up on a day-to-day basis. And the honest answer is it really depends on what your preferences are. Generally speaking, longer liquidity periods, longer maturity trades, they can earn you a higher yield. If you want something that's more liquid, it may be a more commoditized yield. But these are all different levers that you can play with in order to, so quote unquote, like bespoke or customize the type of yield that you're looking for.
And talking about those allocators, what do you see as their profile? You're talking about derivatives there, and you're talking about quite advanced products. Are you seeing them people who are crypto native? Are you seeing people from the TradFi space dipping their toes into it? Obviously, it will be product dependent, but who's coming to you and talking to you?
Yeah. Well, I think a way of answering this question is talking about the environment today in the crypto space and what's transpired over the last 12 to 18 months. And we're seeing 3, 4, 5 different waves kind of all come together that has created this really exciting environment for yield generation. I think one of them is the Wall Street crowd coming in, and there's this idea with Bitcoin as a $1 to $2 trillion asset class now, where you're not going to be getting these 10x moves in a cycle anymore. And it's no longer necessarily early to Bitcoin. Like Bitcoin is a mature institutional asset class. Most people have a little bit of exposure. And yield generation is something that's very native to traditional finance, Wall Street type guys. So we get a lot of that. But then from the crypto native side, it's kind of intersecting. And we're seeing this traditional finance, crypto native archetype come together. And it's innovations on the technology side, credit to what Rootstock is doing and a lot of other Bitcoin innovators, but it's tying, for example, Bitcoin proof of work into the layer 2 security through something like merge mining or BitVM. So we get a lot of traditional finance guys, a lot of crypto native guys. And this financialization that you talk about with the derivative space, this is something that intertwines with Wall Street. But then what's really exciting is there's net new buyers of Bitcoin now. Largely speaking, there's these digital asset treasuries, which have an MNAV that they want to defend. They have a limited number of tools for how they can generate yield, mostly through at the market issuance of equity. We have Bitcoin miners who are now thinking about themselves as commodity producers, and they need to manage their treasury and they need to manage their balance sheet. And then we also have the vault side, which is where the Melo guys come in. And that's kind of creating a new way for Bitcoin investors to stack yield. So it's these 4 or 5 different concepts that I think that are all coming together. It's a very diverse set of investors. There's a lot of education about what does lending yield mean versus what does, posting Bitcoin as collateral, borrowing dollars against that versus what's market neutral arbitrage. And every investor may be at a different point in their journey, but there's now a menu of different options. And I think that's what's really exciting.
Yeah, absolutely. And a great segue there, Etienne. I want to pick your thoughts on this. As Tyler was explaining there's been a lot of change in terms of driving or institutions coming. And he mentioned about the Melo infrastructure. My question is, it doesn't just have to be on the infrastructure side, but why has that happened now? What's changed in the last 12 to 18 months from your perspective? And obviously, with what you've been building out at Melo, why also did you choose to integrate onto the Rootstock chain with Tier Capital?
Yeah, good question. So I guess I'm going to double down on what Tyler just said, which makes a lot of sense, meaning that on the Bitcoin side, I think there are 2 ways to answer the question. The first one on the Bitcoin side, the investors are not the same anymore. Like we've seen a lot of large whales exiting Bitcoin and being replaced by newcomers, which are most likely a bit more like TradFi, traditional finance, the type of investor that is looking for yield. and is keen to explore this type of new yield products. So that would be the first reason. It's also a matter of timing because, as mentioned by Tyler, there is no, I mean, the upside on Bitcoin is not the same today. And so when you're investing in Bitcoin, you're hedging against like a specific types of risk, but you're also expecting additional yield like you would do if you're holding like specific assets like USD, for instance. So I think it's a matter of timing and investor base. Then, generally speaking, for yield products, this is the year of yield products. We are moving away from like pure, like incentive-based products that are dying off in DeFi to much more sustainable products, which are distributed to a much bigger client base through what the Morpho guys coined as like the DeFi mullet. So you're seeing like a lot of custodians, a lot of exchanges, neobanks, wallets, and even Warp.com announced yesterday a yield product using DeFi underneath. So I believe that vaults and yield products and earn programs are the norm in 2026. And so we will see, and I know it for sure, for a fact that we will see in 2026 a lot of growth for such product, not just Bitcoin, but like anything.
Yeah, absolutely. On the Mellow side, what have you, is there anything that you've had to change or you've grown in terms of infrastructure to accommodate some of these institutions coming in, to make them feel at ease and to allow them to allow them to actually take positions in these vaults?
Yes, a lot. I mean, so as I mentioned, like we've been building vaults for 5 years, and the stack that we're building on is completely different now. So the first generation of vaults were active liquidity management vaults, so just focused on trading on AMMs, automated market makers on chain. This is like still working, but it's not like where most of the yield comes from today. Then we switched over restaking, which was there was like a restaking craze maybe like 3 years ago, which went very high and it was quite exciting, but it never really took off, and it's not, as of today, didn't really find like a product market fit. And so we pivoted again and we moved towards like a much more sustainable design of asset management, which is a little bit more close, I mean, much more closer to what Tyler is doing with Tier Capital, where like as the curator, the asset manager is much more actively monitoring and managing the underlying assets to generate yield on lending protocols, on exchanges, on perpetuals, on options. So it's really up to them to pick the right venue. In terms of infrastructure, I would say that today the infrastructure that we've built is fully on chain, so completely auditable. You can see what's happening. You can enforce policies on chain, so you don't just sign a contract. You actually see at a smart contract level that things are allowed or not, and who can do them or not. So it's amazing. I think it's a big upside for finance as a whole. So I'm super excited about that. And it's also super flexible. The stack, the technology is available. The blockchains are performant enough now to enable like much more complex things on chain. And so we can really build like the next generation of financial managed product on chain now. I don't know if you've seen in New York, but I think Matt Coogan from Bitwise just said that vaults are the next ETFs. And I fully buy in. I mean, that's obvious. It's much better stack. And so, yeah, it's just a matter of time now. And regulation.
I hope you do buy in. It'll serve you well in terms of the vault products that you guys are building. I want to ask a question that segues into the big part of like viewing of what risks are out there that people are considering. But Etienne, you mentioned there about investors are, vaults are showing everything on chain. And there's a lot of characteristics about vaults and about on-chain aspects that we think are great because we're from this world. But Tyler or Etienne, is this something where you're speaking to allocators and they're saying we love the fact that we can see everything on chain, or are they kind of like it's not really a big deal for us at the moment? There's other things that we like, and there's other things that we worry about.
I can start if you don't mind, Tyler. Like just on our side, we see both. And actually we have both types of products. We are the official vault providers of Lido, which is the biggest staking provider on Ethereum. They're managing 20 bill. So it's a lot. And we are managing all the earned products of Lido. So these guys, they are very picky. Obviously, they are like securing Ethereum. And so they want fully on-chain things. So that's why we built in collaboration with them this new stack. And so this is the type of ecosystem and partner we work with that is very excited about the fully on-chain aspect. I think when we're dealing with more institutional clients and partners, like you guys and Tier Capital, and Rootstock and all the clients that we're looking into these days, it's a bit different, obviously, because in this case, it's a permission vault. There is an actual contract behind the scene. And there is also alpha. I mean, Tier Capital is generating yield in a way that is, for good reason, obfuscated, because that's how that's unique, right? And you don't want to leak that. And so my point is, I think it's good to have both options, and it's very important for people to know it, right? You don't want to end up in situations with like Stream Finance or FTX, where people expect things but are surprised at some point, right? So that's a very key component of the way you describe the vault to the general public.
Yeah,
Absolutely.
and just to add on to that, a few points. I think what we're seeing in a lot of conversations is there's a certain type of investor who is very crypto native. They've been around for a decade, and there's scar tissue from past cycles of yield generation. And they are only going to invest through a vault because of this concept in crypto where you don't just trust, you verify. And the more components of a vault that you can kind of put on chain and verify, whether it be utilizing ZK proofs or a fund admin attestation, these are levels of comfort that you can give a prospective investor that they wouldn't be able to get outside of monthly reports through a fund administrator. So we're having a lot of those conversations, but beyond the transparency, we actually think there's really cool composability things that tokenization does as a fund that we couldn't do with our traditional stack. And where we're heading with this vault on Rootstock is the ability to take your invested capital, take the receipt token that you're issued from the vault, post that to a lender, borrow more Bitcoin, either for capital efficiency purposes, maybe you're borrowing dollars, maybe you're running a leveraged looping strategy or an institutional carry strategy back into the fund, or maybe you're seeking an early exit for a small discount. Like the fact that we now have a public ledger where you can create more DeFi native opportunities for an investor, we think that's really exciting. And it's just completely out of the picture in the traditional stack. But if you use a vault, you have the tokenized fund, it then opens up maybe investor optionality that's really exciting for more active guys who want to have their hands in something. They really care about capital efficiency. They're managing their own balance sheet. Maybe they're a prop desk. So we think that's very exciting.
Yeah, I would add on to that, from our side, as the infrastructure provider, we speak with a lot of users who are using the Rootstock chain and their businesses, and they are talking to us, and not just from an investor standpoint, they're talking to us as the CFOs and the treasurers who are listening in might be thinking as well. They're looking at the Bitcoin that's sat on their balance sheet, and they're thinking, yeah, absolutely. What can I do to make it productive? What can I do to potentially generate some yield on top of it? But what can I do to help my working capital? What can I do to use it as collateral to get dollar loans? If you're in an industry where you are like Bitcoin miners, where you're earning a lot of Bitcoin, but you're not able to deploy it to pay your OPEX and things like that, then they're interested in seeing what those opportunities are, and I think that's what vaults can afford. And the interesting things that we see as people are building on our chain are, what are the next steps just beyond as you take vaults into the next stage, where it is, okay, I use this as collateral, I then take it and I get a dollar loan against it, or things like that. And so it opens up that door, opens up all those doors to those things. We've got to talk about the risk side a little bit more. Maybe Tyler, we'll kick off with you. What do you hear as the biggest no questions, or the biggest reasons why someone is, or where do they go really deep into the risks of moving their Bitcoin from idle to productive? What are they thinking about as they're bringing it on chain?
Yeah. Well, I think the first question, and this is something that everybody needs to answer for themselves, but it's the philosophical idea of, can Bitcoin be made productive? And, Michael Saylor, love the guy. I think he's been a huge advocate for the space and somebody that's really, perpetuated Bitcoin globally and helped improve adoption. But people listen to these big shot callers like Saylor who say never sell your Bitcoin, never move your Bitcoin, keep it in cold storage. And that's an idea that we think, you can still win if you hodl or hold Bitcoin, but there's a new type of investor and there's somebody out there who wants to generate a low risk yield on their Bitcoin and put it to productive use for the reasons that we stated earlier. Maybe they're miners, they're digital asset treasuries, they're guys like that. But if you can get beyond that philosophical hurdle that one, you don't need to sell your Bitcoin, it can be put to productive use very effectively and in a low risk way, I think you're then ready to start thinking about the other risks beyond the philosophical one. And the most common risk that we see is people want to double click on centralized exchange risk. And I think it's a very smart risk to talk about because this is the issue with FTX. This is the issue with past cycles where exchanges got whacked and then customers and clients lost their assets or had to go through a bankruptcy process to recover them. But in the hedge fund space or the asset management space, we're in the weeds with a lot of different technology updates, and these are maybe things that people who follow Bitcoin, but maybe not from the asset management side, see. Post FTX, there was a product built called Copper Clearloop, and Clearloop is basically this intermediary between asset managers and trading desks and the exchanges. In the past, like I've said, you would sit on these exchanges with your Bitcoin, and then if the exchange went under, you would in theory lose your Bitcoin. But what's happened with Clearloop, which is product built by the custodian Copper, is you've now kind of separated out custody and trading execution into two different models. And I like this idea because it's like the separation of church and state. So now as an asset manager, what happens is we keep about 98% of our assets in a custodian like Copper when we trade, and they're able to mirror balances over onto centralized exchanges so that we can arbitrage these different spot and derivatives products. We can trade options, we can trade futures. And if an exchange were to get whacked in the future or go under or go bust, 98% of your assets are still sitting within the custodian. So this is something that I think it honestly blows a lot of people's minds because they weren't aware that this happened and they're still anchored to past cycles. But one of the silver linings of that FTX debacle was that guys started to look at things from first principles again. They thought, how can we prevent this from happening in the future? And this is where you get this cool piece of technology that actually solves a problem that guys like us would face trying to generate yield.
Yeah, absolutely. I think that touches on a good example, and one of our friends from Utila meant to be here, but obviously Utila provide those MPC custody wallets, and I think that one of the things that we see when we're speaking with people is the first thing they ask is, well, either I already custody my assets with someone like Utila or Copper, and that makes a huge difference to them in terms of just feeling secure and feeling safe. Or their next question on onboarding into the on-chain or the DeFi world is, where do I custody my assets? Because it's such a TradFi-esque idea and thought. You've seen a huge amount of those pop up, and obviously there's some really strong leaders out there, the likes of Utila, who are then being able to come forward and say, well, we now offer such an institutional grade product that through the security, through everything like that, that I think that has reduced a huge hurdle for those people who are initially coming into Bitcoin.
Yeah.
Etienne, anything from your side where you're looking at your build and you're thinking, we want to make sure that through our build, we're keeping risks low, and it's these risks that we think are the biggest things that are stopping people?
Yeah, I mean, I would say that if you're looking at the Bitcoin landscape, generally speaking, these days, there is like, I don't know, maybe 6% of Bitcoin that is held in ETFs, maybe something along those lines as well for in DATs. And if you're holding a DAT, if you're holding an ETF, then you're already compromising and not holding yourself, right? So if you're doing that, then, you know, moving a step beyond and actually using a tokenized Bitcoin on an EVM chain is not that far away, because you're also compromising on the custody side. Because at some point you're maybe like, you know, like the asset is held by a third party, like a BitGo, you know, a custodian that is going to mint a receipt token on the other side on the AVM. Or maybe there is some, you know, technical trick that allows some, you know, bridge to mint in a permissionless way Bitcoin on the EVM, and you must rely on the safety of this bridge, or maybe a consortium deciding that. So there are like so many designs, you know, to bridge Bitcoin to the EVM. So I think that, you know, the difference between holding an ETF, holding a DAT, and holding a wrapped Bitcoin is not, I mean, there isn't much difference. So now the next step is like, do you put it to work or not? My guess is yes, like you have to, if you want to generate additional yield, because of the reasons that we discussed in earlier during the webinar. But, you know, like in the end, it's a matter of smart contract risk. Because like, and obviously like, I mean, in the case of Tier Capital, you need to delegate your capital to some knowledgeable entity. But for fully on-chain products, you need to make sure that you're going to use blue chip protocols and primitives. And so this is what we see a lot today across earn programs and vaults. If you're looking at all the major vaults, they are all tapping into Aave, into Morpho, Uniswap, like all the tier one protocols that are heavily battle tested. And so I don't see a difference on the Bitcoin side. I think that, you know, if you take a little bit of risk with your stablecoins and you're fine with the earn program on USDC, why not on Bitcoin? It's not that different.
And when you're talking about, we might have some people who are listening who aren't really sure about what smart contracts or smart contract risk is. Eddie, would you mind just giving us a quick briefing of, you know, what is a smart contract, and why is that needed in an EVM chain, and obviously I can go into that a little bit as well, as Rootstock is EVM compatible, but just from yourself.
Yeah, of course. I mean, like at a very, very high level, like the Bitcoin that you're sending into the vault is held by no one but a smart contract, which is a program that we have defined ourselves, and which is running more or less autonomously and deploying capital into various venues, depending on specific rules that are enforced on chain. So think of it as a contract, but running autonomously on a computer, right? Usually the program is going to deploy the Bitcoin on a lending venue, or stake it to secure some system and generate yield. Maybe deploy it on a lending venue to borrow stable coins, and then deploy the stable coins across other venues to beat the borrow rate and generate additional yield on the Bitcoin. Or it's going to delegate the Bitcoin to some sophisticated entity that is going to run advanced strategies across options markets, derivatives, on-chain and off-chain, like Tier Capital is doing.
Perfect. Yeah, absolutely. And I'm going to follow up with on that question with another one related to yourself. I think for most institutional compliance teams, the controls question is quite important, right? So smart contract, who's controlling what, how is that controlled? What controls does your Vault infrastructure actually support? And I'm talking about whitelisting, role basing, and things like that.
So it's a good question, and it's a very interesting one, because I mean, when you're looking at the institutional space and like products these days, it's mainly off-chain, because people are used to sign contracts and, you know, like read through them and understand how things work. But I strongly believe that as we move forward, contracts will replace to some extent. I mean, smart contracts will replace to some extent contracts, because you can really see on-chain and enforce things in a way that is that you can force, right? So it's literally built as is, and you can change things. So to get back to your question, like I would say that for the Melo case, we have 150 permissions, so highly granular. So think of it as a contract, and we can define who can do what in what conditions, who can deposit into the vault, which amount, how can you withdraw the money, who can withdraw the money, what can Tier do with it or not, which protocols can be used. So it's really like a shell, which is very, very granular in terms of permissions, and allows to like you can believe the vault essentially. If you can read smart contracts, which hopefully you can, then you can trust us in a sense. You don't even have to trust us.
Yeah, and Tyler, similar question to yourself. When you're speaking to these people wanting to move into productive Bitcoin, are they coming to you with the same asks of reporting, NAV reporting, and things like that they would from the TradFi side of things? More, less, and what sort of things can you offer?
Yeah, well, I think this ties in a little bit to your last ask on, like, what are the risks that people talk about and what questions they ask. And there's a huge overlap with the institutionalization of the crypto space and the level of reporting requirements and due diligence questions and the types of materials and documents that we produce for prospective investors. So guys are asking about your Sharpe ratio. They're asking about your yearly track record. They're asking about how many negative months have you had in your history? What is the volatility of the fund? What is the max drawdown? Is this audited or independently verified? Is it posted on-chain to a vault? What is the frequency of those reports? So we get a lot of questions in this field, and it's certainly something that I think is exciting because we have a track record going back to 2018 in the space. We've been running these strategies for almost a couple decades now across asset classes. So it leans into one of our strengths, which is reporting, which is the track record, the team, all of these things. But I think it's good for crypto. I think it's good to have, a level of due diligence that is serious, it's sophisticated, it's in line with traditional finance standards. And I think this is what we're seeing with both vaults, but also on the traditional fund side, is investors demanding more, requesting more, being more thoughtful and prudent about where they allocate, managing their balance sheet responsibly. So these are all trends that we see.
Yeah, which I think is a super important thing. And I think that when we're, again, working with partners such as yourselves, and also with speaking with people out in the industry, the more serious that this world can get and that more institutionalized that this world can get, the better in a lot of instances. I think, again, going back to a point that you made very early on, Tyler, people have learned and got scar tissue from things that happened. And I think that next wave of builders and that next wave of offerings are taking all of that into account and taking all of those things with not just a pinch of salt, but with actually a view that this isn't just a nice to have. This is a fundamental requirement of what people expect, because the people within this world are a lot more serious and more serious players in terms of what they're wanting to do. Their balance sheet depends on it, their corporate treasury depends on it, or their performance from a fund perspective depends on it. So yeah, I absolutely agree. Moving into a little bit on I really, as we said at the beginning of this, I want to focus on the operational side rather than the theoretical side. And so I'd love to talk about the actual life cycle of coming into a vault, working with yourselves. What does that look like? In terms of stages, right? How do people do it, and what process do they go through, and how do they actually interact?
Yeah,
That can be either Tyler, Etienne, because obviously you both touch it at different stages.
yeah. I'll touch on it from the tier side first. So very practically speaking, just about a month and a half ago, we tokenized our fund. We launched it on Mello. It's the same strategies, the same track record, all the same types of yield generation that our team has been running since 2018. The difference is it's now tokenized, and we've enabled some of these different pieces that we were talking about earlier that a vault provides. So you go to Mello Finance, you go to their website, you onboard to our fund admin, independent fund admin who audits our track record. They provide NAV. They ensure the fund is following all of our policies and procedures. And you onboard, you do the KYC, AML checks, get your wallet screened. Once your wallet is whitelisted, you can then allocate it into the fund. So when you come into the fund, you deposit your RBTC. So we're over on Rootstock now, layer 2 on top of Bitcoin. You allocate your RBTC into the vault. Tier Capital takes the underlying Bitcoin and then goes and runs market neutral strategies, arbitrage strategies on the Bitcoin to generate a Bitcoin denominated yield with the target around 10 to 15% Bitcoin on Bitcoin terms per year. And that's net of fees. Monthly, you get a performance report. We post a NAV that will, in theory, update the amount of Bitcoin that you have and that you're entitled to if you were to redeem. And all of the redemption subscription processes happen basically autonomously through the Melo Vault. And we utilize Utila for our on-chain operations. And this goes back to a point I wanted to make earlier, but Copper is sort of the CeFi interface that we use to trade across derivatives exchanges. And Utila is our on-chain specialist for moving Bitcoin around, interacting with the vault, and doing all the things from an asset management perspective that we need to do there. So this is just a high-level overview of how the vault works and, practically speaking, how an investor comes in.
Got it. Etienne, anything to add from your side?
I mean, I think what Tyler just said is point on and on point. And like, just to add on that, like, I would say that the vault itself would prevent anyone to do anything else than what Tyler just said.
Awesome, very good. One last question from my side, and you, Etienne, you can't use the example you've already given of vaults being the ETFs of the future, but over which everyone loves to ask on these sort of webinars or podcasts, where do you see us in 2 years' time in the space of moving Bitcoin from idle to productive capital? You know, what do you see the trends being, even some of the blockers that we might have to get around to get there? And Etienne, I'll put you in the hot seat first. What are you expecting? Everything to be on vaults or specific things?
I hope so. No, I don't think so. I mean, like, I think the space is wide and you know, like, not homogeneous. So we will see both, like, people that keep holding Bitcoin in a idle phase and some people that put it to work. And I believe that the large majority of people will use vaults because that's the most like simple way from a UX point of view to deploy capital in a productive fashion. This is what we do. This is what we see today. And I think that we're like at the beginning of the S-curve. Literally all the custodians, which are a blocker today for institutional investors because they need custodians to deploy capital, right? They are all working on earn programs as we speak. So I can tell you. So it's a big topic. I expect by the end of the year, most of the custodians to provide solutions for Bitcoin, for stablecoins, for RWA, for ETH and other crypto assets. And so, yeah, beginning of the S-curve, maybe 2 years, like maybe double digits. We'll see. Maybe it's a bit too much. I don't know. But yeah, I'm optimistic. We'll see.
Awesome. Tyler, your thoughts?
Yeah, this is a very fun question. I think there's so many different things that are happening right now that are all intersecting, but I'll give you a couple concrete predictions. I think in the next 12 to 18 months, it will be unusual if a digital asset treasury company or a Bitcoin miner is not utilizing their balance sheet productively. I think what we've seen in the last 6 to 12 months, especially, is the at-the-market issuance of equity, which is selling equity, taking the dollars, buying Bitcoin. That flywheel is broken, and it's structurally broken because you can't sell, something for more than it's worth and just run that in perpetuity. You're naturally going to hit a level of demand where it taps out. So I think we'll see digital asset treasuries and miners putting their Bitcoin to work productively. I think on top of that, we're going to see a lot more focus on real yield. We touched on it a little bit earlier, but yield can mean many different things. It can mean lending. It could mean posting your Bitcoin as collateral, borrowing dollars, putting that to productive use. It could mean derivatives. It could mean emissions, which are like governance tokens that a protocol may reward as an incentive for using their protocol. It could mean points, which are a vague promise for future tokens. But I think with what we're seeing is people realize that real yield is the key, and real yield in traditional finance means something very concretely. And there's a very specific way that asset managers and hedge funds go and seek yield. So I think we're going to see crypto. This is like a larger trend that I've seen over about the decade that I've been in the space. But crypto repeats and learns some of the things that TradFi had to learn. Maybe it's 20 years ago or 50 years ago or 100 years ago, but we're speed running a lot of the same lessons. So I think we'll see a focus towards real yield being how the industry broadly defines it. And I think vaults are going to be a big piece of that, because now the onus is not on the retail investor or the high net worth or the family office to go and manage all these complex strategies themselves. They will take what we've learned from traditional finance and put a crypto wrapper around it in vaults and say, hey, I'll delegate a portion of my balance sheet to this vault or invest into this vault. And then I'll let the manager who's doing this 24/7, 365 focus on yield. And it's not binary, just like owning Bitcoin isn't binary. It doesn't mean I need to go all in or go 100%. I think we'll see sophisticated teams come in, get off zero, put 5 to 10% to work, get comfortable with it. They'll manage their balance sheet risk. Maybe they'll seek a diverse set of opportunities. But the trend that we're very much so seeing is people are looking to monetize their Bitcoin. So I think this goes vertical in the next 1 to 2 years. In the next 10 years, it won't even be a topic of conversation. It'll just be what people do. But where we're sitting right now, there's so few Bitcoin that's being put to productive use. It's just an unbelievably asymmetric opportunity. And there's this old saying, which I love, and I think with the work Rootstock's doing, the BitVM, ordinals, runes, all of this stuff that's happened in the last few years, it signals that any technology better than Bitcoin will eventually be adopted by Bitcoin. So we're going to see Bitcoin kind of evolve. I think beyond digital gold, it will take some time for people to wrap their heads around it, but it isn't just that. And I think it's a great meme and it's a great archetype or idea to think about to explain Bitcoin to somebody who's new, but I think it's going to be so much more. So those are a couple of my predictions.
Awesome. Brilliant. Well, what a way to round that off. Thank you both. So we've got a couple of questions that have been sent through. One of them is how does Rootstock's security model compare to other Bitcoin L2s or wrapped Bitcoin solutions? So obviously, I'm probably best placed to answer that, or I should be. So Rootstock is a Bitcoin sidechain layer 2. There's multiple definitions, but you can kind of marry them together if you're not too bothered about what that means. And we are EVM compatible. And so when Rootstock was built, the contributors and the builders focused a massive amount on security. And that came through, I think, really in 3 different ways. The first of which is what we call merge mining. And so merge mining is basically where miners who are mining the Bitcoin layer 1 can also mine Rootstock. And Rootstock is a proof of work chain, right? As opposed to others that are proof of stake, we are proof of work. And so 80% of the hash rate that secures the layer 1 secures Rootstock. So what that really means is that 80% of the miners mining Bitcoin layer 1 are mining the layer 2 of Rootstock. So that offers a huge amount of security. It basically means you have to have 80% of all the Bitcoin in supply to be able to do anything that is any problematic to the chain. The second, I think, is the structure around our token, which is, or RBTC, which is our wrapped version of Bitcoin. And so that is the different types of wrapped version of Bitcoin, as actually I think Tyler alluded to earlier. But Rootstock's RBTC is decentralized. It's not held by custodians. Others maybe have single custodial risk. They are managed off-chain. RBTC is not. It is fully decentralized and it is not held by custodians. It is held by what we're going into, which is within the PowPeg bridge. So proof of work, POW, PowPeg bridge. And this is how you move from Bitcoin to the wrapped version of Bitcoin. And again, I think Etienne touched on it earlier about you got to think about bridge risk and things like that. And so that is, well, once I move my Bitcoin onto a layer 2, Where is it? What happens? And there's many different versions. The PowerPeg bridge is a decentralized bridge. It's not controlled by a centralized entity. It is overseen by what we call pegnatories, which is it's a federated bridge. So there are pegnatories who are overseeing this bridge. We have no control over it, neither do they as individuals. It is as a group. So yeah, it's not something that is ran by a centralized entity, and it's not something that is controlled by us in any shape or form. So that's why we think that our chain and our wrapped version of Bitcoin and our bridge is the most secure out there. Your next question, can you break down the difference between earning yield directly through DeFi protocols versus going through a managed vault? Who is each path best suited for? So I'll open that up to either Etienne or Tyler.
Yeah.
I'll take a piece of this. So largely it just depends on how active an investor you want to be and what your skill set is. If you are investing and seeking to generate yield in a DeFi protocol, you really need to know how to underwrite all of these different risks, like the smart contract risks that Etienne talked about. You need to understand where the yield is coming from. Is it coming from emissions? Is it coming from a leverage strategy? Is it rehypothecated? Is it for restaking? Like, these are all the different questions that you need to answer. So it's a very active role. The thing with a vault is that you are now delegating that risk management to a professional asset manager, hedge fund, trading desk. Whoever is managing the vault is underwriting all of those risks on your behalf, and they have a public track record that you can typically see. They might be reporting yield on a 7-day basis. Maybe it's a 30-day basis or a quarterly basis, but the vault manager is effectively taking on the role as a fund manager. And when you invest into the vault, you're delegating them under the mandate, under the policies that are set to go generate yield on your assets. So that's the key difference.
Yeah, I agree. I mean, there are like two components, two aspects of it. Like the first one is whether you can do it or not, because, to access to on-chain protocols and DeFi protocols, you need some tools. So you need a wallet. Even better, you need a hardware wallet like Ledger to interact with the protocol in a safely manner. So if you don't have that, you just can't, right? So if you want to try, buy some wallet and use a DeFi protocol, but then it's a matter of skill, right? So do you want to spend the time? And it's risky because, in blockchains, you don't want to make mistakes are difficult to it's difficult to take a step back when you're making a mistake, right? Because transactions, when they are done, they are done. So it's better if you want to take the time to learn, to delegate that to a professional asset manager. And the best way to compare that with more traditional products is whether you're doing stock picking yourself or delegating to a managed product, or just deploying your capital into a savings account, right? So a saving account is a vault. Stock picking is doing it yourself.
Amazing. Brilliant. Tyler, Etienne, thank you so much. Pleasure to speak to you both as always. And I think, look, I hope for everyone listening and or watching that you can see that this isn't a theoretical conversation anymore. It's really truly moved into an operational one. And the reasons for that is obviously around the fact that the infrastructure is there, the custody solutions are there, that the products are there in terms of what you can actually put things Bitcoin into. Tyler, what's the best way for someone to reach out to you if they've got any follow-up questions?
Yeah, I don't know if it's easy to type up my email here, but it's twelliner@tier.capital. So it's just first initial, last name, which you may be able to see on the screen here, and then @tier.capital.
Awesome. Etienne, how can people get in touch with you?
You can send me an email on etienne@melo.finance. So Etienne, ETIENNE. Otherwise, you can just go on melo.finance and look by yourself, if you have a ledger, obviously, to find the best vault.
Amazing. All right. Well, thank you everyone for watching and listening. And obviously, if you'd like to reach out to us at Rootstock Institutional, please feel free to do so. You can go to rootstocklabs.com/institutional. We appreciate you all, and thank you again, Etienne and Tyler. And we bid you farewell.
Thank you very much.
Thank you, guys. Take care.
Bye-bye.
Thanks, everybody.